Thanks for joining David, Kevin, and myself for the market update for the month of March. Markets were very strong again in March and really continued the momentum on since November of last year. The U.S. S&P 500 was up 3.1%. Canadian stocks, as reflected by the S&P TSX index, was up 3.76%. And the EAFE region also performed well in March. They were up 2.78%. The only market that saw a little softness was the emerging market, and in particular China was lagging most of the other regions. The loonie was actually a little up in March, up 0.3%, but overall so far this year we've seen it down 2.19 compared to the US dollar, and a lot of that is because the Canadian market is much more interest rate sensitive. I'm going to pass you on to the guys. They'll give you the rest of the update, but as always, if you have any questions, need anything, please don't hesitate to give us a call. Thanks and take care.
David, how have things been looking in the world's largest economy?
The U.S. market continues to do really well as far as the stock markets are concerned, and that is due in large part to the fact that its economy continues to be very strong as well. The fourth quarter GDP number was recently revised upward for 2023 in the United States. It's been revised up to 3.4% annualized on the back of stronger household demand and business growth as well. Meanwhile, consumer sentiment in the United States rose to the highest level in March of 2024 since back in 2021. Pending home sales gained 1.6% in February, which is another good sign for the U.S. market. Amid this backdrop of solid U.S. economic growth, it seems that the Federal Reserve is going to continue to preach patience around when interest rate cuts are going to start taking effect. Clearly, with inflation still being a little bit stubborn and not quite back down to the 2% level, and with the economy being so strong and unemployment very low in the U.S., Fed Chair Jerome Powell is in no rush to necessarily have to cut interest rates. And so this is something that we're going to be watching unfold for the rest of the year in the United States. How have things been shaping up in Canada recently, Kevin?
Statistics Canada, or StatsCan, reported that our economy grew by 0.6% in January, up from the 0.4% that they had as an estimate. StatsCan also estimated that our GDP grew by 0.4% in February, marking the second straight month of growth. Canada's economy is displaying relative strength at the beginning of 2024, pointing to the possibility of outpacing expectations. Now, this also shows that the Bank of Canada is maybe on the right track with holding rates where they are, at least for now.
All in all, 2024 has been off to a fantastic start, especially for North American equity markets. Canadian and U.S. stock markets are both back at record highs that we last saw at the end of 2021, early 2022. Now, certainly many people have been seeing these headlines that stock markets are back at record highs and continuing to reach new record highs almost every week in the past few months. Now, some investors, especially contrarian investors, may be inclined to try and time the market and say, hey, if this is at a record high, maybe it's time to cash out and take some profits for a period of time. We wouldn't advocate that for a couple of reasons. Number one, after many years in this business, I've seen investors try and time the markets before based on a hunch, and it's very, very difficult to do. Really, it comes down to just getting lucky. Number two, just because something is at a record high doesn't necessarily mean that it can't reach new record highs. After all, records are made to be broken, weren't they?
That's right, David. And just because we're seeing record highs in North America right now, certainly doesn't mean that we won't continue to see new record highs in the coming weeks, months, and years. New highs tend to cause hesitation, but often lead to more new highs. Since 1950, there have been new all-time highs on 6.7% of all trading days. In the 1990s, it was more than 12% of all trading days. And from 2013 to 2019, it happened on 14% of all trading days. Despite two bear markets this decade, the S&P 500 has hit new all-time highs on 11% of all trading days in the 2020s. Here are the new highs by year since 2015.
Another potential catalyst for the markets is the record amounts of cash on the sidelines today. Today, over 1.6 trillion US dollars worth of cash resides in cash or money market funds. As interest rates inevitably start to get cut by central banks, logic would lead us to believe that some of this money that's sitting in cash on the sidelines will look for a new home, some of which will likely flow into stocks for the dividend yield and growth potential that stocks offer.
As always, if you need anything, please don't hesitate to reach out to Harry, David, or myself at any time.
Take care.